love the channel and find it useful in becoming a happy retiree. Subscribe today. Good morning. Welcome to the show. How can I help?
Good morning. I'm essentially calling as a follow-up question on your discussion about stocks and bonds and their inverse relationship. I guess, between the bonds kind of rising over the last decade, along with stocks not as high, I'm envisioning that maybe we might not return to sort of the inverse relationship we historically have seen, primarily because inflation also might be playing a big role of that. I was just wondering if you wouldn't mind commenting on it, and maybe what other safety options would investors have to put their money in during this time?
Here, Elvin, I think that this is something that struck me in the last couple of weeks when it comes to bond investing. We talked about in an earlier caller kind of the normalization of getting back from ridiculously low rates because of quantitative easing, the Federal Reserve making sure rates stay low, artificially low. And we had a 10-year Treasury yield that historically is in the 4% range, right? Over time, 4, 4.25, 4.5. Got down to 1.5 or even lower for shorter periods of time. So we have this pressure that has kept rates lower. What we're seeing this year is rates are headed higher, and they're getting back to more normal levels. We're getting close to 3% now in the 10-year Treasury. Something important to note, if you go back about a year, the 10-year Treasury bond, so in order to get, government, 10-year government bond yielded 2.1%. That's how much you would get on every year for 10 years. Today, the 2-year government bond yields the same as it did the 10-year. So now to get 2.1%, you can get a short-term 2-year Treasury. And the 10-year is now approaching 3%. So what I think is happening here, Elvin, is that we're getting back to more normal rates. As that happens and rates go back up, it's a tough period of time for bond investors. As rates go back up, the inverse relationship between prices and yields, yields go back up, prices come down. But once we get back to a more normal level, 3.5%, 4%, which we're not that far away from, bond investing becomes similar to how it's been over time. And that correlation, or that inverse correlation, so that bonds save you while stocks correct, that relationship, the reason we hold these safe assets, that comes back when rates normalize, and we're getting closer and closer to that period of time. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.